In today's fast-paced financial landscape, understanding the lessons from past economic crises is more crucial than ever. History has a way of repeating itself, and by examining the patterns of previous downturns, we can better prepare for the uncertainties that lie ahead. In this video, we will delve into significant economic events, such as the Great Depression of the 1930s, the dot-com bubble of the late 1990s, and the 2008 financial crisis. Each of these crises offers valuable insights into the behaviors and decisions that led to widespread financial chaos. The Great Depression serves as a stark reminder of how quickly economic stability can crumble. It teaches us about the dangers of speculation and the importance of regulatory frameworks. Moving forward to the dot-com bubble, we see how overvaluation and investor exuberance can create an unsustainable market. This period highlights the necessity of due diligence and the risks associated with technological advancements. Finally, the 2008 financial crisis underscores the significance of transparency and accountability in financial institutions, revealing how interconnected our global economy truly is. By analyzing these historical patterns, we can identify warning signs and develop strategies to mitigate risks in our own financial decisions. Learning from the past not only equips us with the knowledge to navigate current economic challenges, but also empowers us to anticipate future events. As we explore these crises, we will uncover the common threads that link them and discuss how they can inform our understanding of today's financial environment. Join us as we embark on this journey through history, uncovering the lessons that can help us navigate the complexities of our modern economy and ultimately achieve financial resilience. An economic crisis is a significant disruption in the functioning of an economy, often characterized by a sharp decline in economic activity, rising unemployment, and a loss of consumer and business confidence. These crises can manifest in various forms, including recessions, depressions, and financial market collapses, each leaving a profound impact on society and markets. The consequences of an economic crisis can be far-reaching, affecting everything from individual livelihoods to global trade dynamics. Historically, we can observe different types of economic crises that illustrate their diverse nature. The Great Depression of the 1930s is perhaps the most infamous example, marked by massive unemployment and widespread poverty. This crisis was triggered by a stock market crash and was exacerbated by bank failures and a lack of consumer spending. In contrast, the 2008 financial crisis stemmed from the collapse of the housing market and the subsequent failure of major financial institutions, leading to a global recession. Each of these crises highlights unique triggers and outcomes, yet they share common characteristics, such as a loss of trust in financial systems and a rapid contraction of credit. One of the most important aspects of economic crises is their cyclical nature. Economies naturally go through cycles of growth and contraction, and while periods of prosperity can seem endless, downturns are often inevitable. This cyclical behavior is influenced by various factors, including changes in consumer behavior, government policies, and external shocks, such as geopolitical events or natural disasters. Understanding this cyclical nature is crucial for individuals and businesses alike, as it prepares them to navigate the inevitable ups and downs of the economic landscape. In summary, economic crises are complex events with significant implications for society and markets. By examining historical examples and recognizing the cyclical patterns of economies, we can better equip ourselves to face future challenges and mitigate the impacts of potential crises. Examining historical economic crises provides invaluable insights into the complexities of financial systems and the lessons we can apply to today's economic landscape. Two pivotal crises that stand out are the Great Depression of the 1930s and the 2008 financial crisis. Each of these events not only reshaped economies, but also left lasting impacts on global financial practices. The Great Depression began with the stock market crash of 1929, which triggered a cascade of bank failures and a dramatic decline in consumer spending. Unemployment soared, reaching nearly 25% in the United States, and the global economy contracted sharply. The effects were felt worldwide, leading to widespread poverty and social unrest. One of the key lessons from this crisis is the importance of regulatory oversight. The lack of financial regulations allowed for rampant speculation, which ultimately contributed to the market's collapse. In response, governments implemented measures such as the Glass-Steagall Act, which aim to separate commercial and investment banking, highlighting the need for a robust regulatory framework to protect economies from similar downturns. Fast forward to 2008, when the financial crisis erupted due to the collapse of the housing market and the proliferation of subprime mortgages. Major financial institutions faced insolvency, leading to a global recession that affected millions. The crisis revealed the dangers of excessive risk-taking and the interconnectedness of global markets. One critical lesson learned was the necessity for transparency in financial products and practices. The crisis underscored the importance of understanding the risks associated with complex financial instruments, prompting calls for greater accountability and reform in the banking sector. Both the Great Depression and the 2008 financial crisis serve as stark reminders of the vulnerabilities inherent in economic systems. By analyzing their causes and effects, we can extract valuable lessons about the importance of regulation, transparency, and risk management. These insights are essential for navigating current financial situations and preparing for future economic challenges. As we delve into the patterns observed in past economic crises, it becomes clear that certain recurring themes and indicators can signal impending downturns. By identifying these patterns, we can better prepare ourselves for future economic challenges. Common indicators include rising unemployment rates, increasing levels of consumer debt, and significant fluctuations in stock market valuations. Additionally, the behavior of interest rates often serves as a crucial signal. For instance, when central banks raise rates to combat inflation, it can inadvertently slow down economic growth and trigger a recession. Historical data plays a vital role in informing current financial strategies. By analyzing past crises, we can recognize the warning signs that often precede economic turmoil. For example, the lead-up to the 2008 financial crisis was marked by a surge in housing prices and a corresponding increase in mortgage lending, particularly subprime loans. These trends, while initially appearing positive, ultimately masked underlying vulnerabilities in the financial system. Understanding these dynamics allows investors, businesses, and policymakers to make more informed decisions and develop strategies that mitigate risk. Encouraging viewers to think critically about future economic trends is essential in today's rapidly changing financial landscape. As we face new challenges such as technological advancements, geopolitical tensions, and climate change, it's crucial to remain vigilant and adaptable. By applying the lessons learned from historical crises, we can better anticipate potential disruptions and adjust our strategies accordingly. In conclusion, recognizing the patterns and indicators that have historically signaled economic downturns empowers us to navigate the complexities of the modern economy. By leveraging historical data and fostering critical thinking, we can enhance our ability to predict future trends and make informed financial decisions. As we move forward, let's remain proactive in our approach, using the past as a guide to navigate the uncertainties of the future. In times of financial turbulence, applying actionable insights from historical lessons can significantly enhance our ability to manage personal finances effectively. One of the most important tips is to maintain a well-structured budget. By tracking income and expenses, individuals can identify areas where they can cut back and save, ensuring they have a financial cushion during uncertain times. Additionally, building an emergency fund that covers 3 to 6 months of living expenses can provide peace of mind and security when unexpected challenges arise. Another crucial lesson from past crises is the importance of diversification and risk management. Relying too heavily on a single investment or asset class can expose individuals to significant risks. Instead, consider spreading investments across various sectors, such as stocks, bonds, real estate, and commodities. This diversification can help mitigate losses during market downturns, as different asset classes often react differently to economic changes. Furthermore, regularly reviewing and rebalancing your investment portfolio can ensure that it aligns with your risk tolerance and financial goals. Proactive financial planning is essential in navigating uncertain times. This involves not only setting short-term and long-term financial goals, but also regularly assessing and adjusting them based on changing circumstances. For instance, if you anticipate a potential job loss or economic downturn, consider developing alternative income streams, such as freelance work or passive income opportunities. This proactive approach can provide additional financial security and flexibility. Lastly, staying informed about economic trends and potential market shifts is vital. Regularly consuming financial news and analysis can help you make informed decisions and adapt your strategies as needed. By combining these practical tips with lessons learned from historical crises, you can better navigate the current financial landscape and position yourself for future success. Remember, the key to thriving in turbulent times lies in preparation, adaptability, and a proactive mindset. As we wrap up our exploration of navigating financial chaos through lessons from past economic crises, it's essential to recap the main lessons learned. We've examined significant events like the Great Depression and the 2008 financial crisis, highlighting the importance of regulatory oversight, transparency, and risk management. These historical examples remind us that economic downturns can arise from various factors, including speculation, excessive debt, and a lack of accountability in financial systems. One of the key takeaways is the cyclical nature of economies. Understanding that downturns are inevitable allows us to prepare and adapt our financial strategies accordingly. By recognizing the warning signs and indicators that have historically preceded crises, we can make more informed decisions about our personal finances. This includes maintaining a budget, building an emergency fund, and diversifying investments to mitigate risks. Applying these lessons to our current financial decisions is crucial. In uncertain times, proactive financial planning and adaptability can make all the difference. By staying informed about economic trends and adjusting our strategies, we can navigate the complexities of today's financial landscape with greater confidence. We encourage you to engage with this content by subscribing to our channel for more insights on financial literacy and economic trends. If you found this video helpful, please give it a thumbs up and share it with friends and family who may benefit from these lessons. Your support helps us continue to provide valuable information that empowers individuals to make sound financial decisions. Thank you for joining us on this journey through history and finance. Remember, the lessons of the past are not just stories. They are tools that can guide us toward a more secure financial future. Stay proactive, stay informed, and let's navigate the challenges ahead together.